Okay, as we look at the Palantir stock price right now, 25, 44, 43, our call options are in the money. I have call options for $23 that expires tomorrow. So there are so many different things we can do with these option contracts. I'm going to show you 4 options and let's do like why you want to do each one. Welcome back, mindful investors. As I said in previous videos, there are always options with options. And when you have call contracts that are in the money, it usually means that you're profitable. Because when I buy call options, I buy them out of money. And when they turn from out of money to in the money, it generally means you're in the green. So that's a good problem to have. Now you have all these contracts, but what do you do with them? Do you just sell them out? Do you roll them? Or are there other options with these options? Let's find out. Okay, so these are the contracts that expires tomorrow, June 18th, $23 calls. Right now, the stock price is at $25.36.37. And now I'm going to show you the 4 different things you can do with these contracts. So as you can see here, my long position has 20 contracts and the average price is 54 cents. Right here, I have some GTC orders, which means good till canceled. What that means is that in case the stock spikes during the day, most of the time I don't pay attention to the stock price. In case it spikes up like 5-10%, I can cash out some of these positions. I can dollar cost average out. So I like round numbers. 54 cents to 270 is a multiplier of 5. 324 is a multiplier of 6. So I actually had more of these, but some of them got covered. For instance, the 4x at 216 probably got covered earlier today, which is fine. I'm profitable for 4x. These two are for the 5x and 6x, which is still a huge bonus if I hit it tomorrow. But right now, I'm going to take some profits off the table to make this video. So with these 20 contracts, I'm going to do 4 different things. Number 1 is just sell it. So right now, if I just sell it, I'm going to just sell 5 contracts right here. 5 contracts at $2.42. Let's try it. 42 cents, 5 contracts. Okay, it's not executing. I'm going to lower it a little bit at 240. So this is a general process. You just drop it down by a couple of cents and then refresh. 235. This has to hit. Come on. So the stock price should be tanking a little bit right now. So that's why it's not executing. I have to drop it a little bit more at 233. Let's try. 233 is not executing. If we look back at the stock price, we see that it's tanked a little bit at 25.31, 32. So we have to go back and it executed 5 contracts at 233. Okay, so that was the first action. Just sell some contracts. Sell contracts. And what I did just now was sell it at 233. I bought them at 0.54, which equals 1.79 times 100 shares per contract times 5 contracts I sold. So that equals $895. Okay, that was quite simple. You buy some contracts and you just sell it to settle the contracts. The second way is more interesting. It's called rolling the contract. For this contract that expires tomorrow, I don't have too much room. It has to blast off within the next 24 hours for me to get more profits. But sometimes I want to buy more time for this action to take place because I never know when they'll blast off. So I do have some play money. As you can see here, the 233 premiums is my play money. So I plan to roll this out to a further date and possibly at a higher price as well. So let's see what we can find. For my brokerage, Interactive Brokers, I have the function to roll position. If I roll it to July 16th, it'll be 26 days away. Let's see what we can get for 233 premiums. So if we scroll down for 233 premiums, we can go to $24. What that means is that for this contract to be profitable, the stock price will have to be 24 plus 2.24. So around 26.24 in 30 days. If I want to roll my position into this contract, do I feel that this trajectory will just continue up? That is exactly what I'm saying. At this trajectory, that went from $18 to $25. To connect these 2 dots and draw that line. Let's draw that line. We started at $18 around mid-May. And right now is at $25. And we're connecting these 2 dots. So connect the dots. And if I want to roll the positions into July 19th, I'm pretty much saying that this trajectory will continue. Like that is the premium that's being priced in. Well, it's all up in the air, but sometimes I take these gambles because I do have other positions like this one. Okay, so as you can see here, I already have August $29 call contracts, 100 of them. So these 5 contracts doesn't really matter. I'm just gonna roll it to July for the video sakes. Let's go back to this position right here to July, $24, roll. So as you can see here, we're doing a combination of 2 actions at the same time. We're selling the June $23 calls and buying the July $24 calls at the same time. We're going to execute 5 contracts, and this is generally how I roll contracts. I roll with a credit back. Instead of piling more money into it, I just use that premium that's collected from the June contracts and rolling it to the July contract. So I'm not piling more money into this play. Negative 0.2, let's try that. Right here it says credit of 20 cents per contract. If we do a quick preview, we won't be taking money out of the account because the commission is $12 and we're collecting 5 times $20, $100. Okay, submitted but not executed, so I have to lower it a little bit more to 15 cents maybe. Order filled. So now I have some July contracts, 5 long contracts, July $24 calls at an average price of $2.08. In order for this position to break even, it has to go above $26.08 by July 16th. We'll see what happens with these. So that was number 2. Number 2 was rolling the options further out. Okay, right now into number 3. Number 3 is exercising the contract, which means I'm going to buy these shares at that strike price, at the $23 strike price. Even though the stock price right now is at $25.30, I'm going to execute it and buy it at $23. Normally I don't do this action, but let's find out for this video. If we click on exercise, I have a position of 10. I'm going to exercise 5 of them. Make final. What does that mean? Okay, let's try to submit without making final and see what happens. Has been submitted. Okay, does that mean I have to wait? I'm gonna cancel it. Okay, there was that screen back then that showed that it'll execute by 5:30 today because there is no urgency to execute it since the option contract is so deep in the money. And this action to exercise a position isn't sensitive to the price fluctuations because I'm gonna execute at $23. So whoever that sold the $23 calls at June 18th, 2021 has to sell me the 500 shares that they owe. So these 500 shares may be covered like maybe after hours today or sometime tomorrow. Let's try it one more time with the make final option. Okay, I'm gonna check this box this time. Deadline is 5:25. Currently the option's in the money by 2:36. Make final and let's see if it executes right away. This exercise request will be final. Once submitted, the option position and stock position will update immediately. Okay, let's fly with that. Wait. Let's cancel it and see how many shares I have in this account. Right here it shows 10,440, 10,440 in this account. Make final, submit. Okay. So that exercise at $23 at question mark because it doesn't matter what price it is right now. They're obligated to sell me the 500 shares at $23. Now let's go back and see my position. Okay, that worked fine. We have a long of 10,940. Before it was 10,440, so a difference of 500 shares. It worked. Okay, another option right here is as close position. If we click on that, it just means to sell it back. So we bought something, we sell it back, and we close the position. That's exactly the same as what we did when we sold the contracts. The same as closing positions. Okay, so that was 3 of the different actions that we can do when your contracts are in the money. The 4th one is to just let it fly. Let it fly until expiration. In my case, is tomorrow. We let it fly because it's like a quadruple witching day tomorrow. So some crazy volatility might happen. There might be some short squeeze. There might be some other things that can happen. So I'm just gonna let these 5 contracts fly. And by the end of tomorrow, if I do absolutely nothing and the stock price remains above 23, they'll just automatically help me exercise the contract. So they'll exercise another 5 contracts times 100 shares at $23 automatically. So I don't have to do anything. We'll see what happens tomorrow. If it shoots up even higher, I might just settle the contracts. Actually, I think either way, I'll settle it. I don't want to exercise more positions currently. So that was the 4 options I can do when your contracts are in the money. Is one way better than the other? Well, no. It depends on your situation, right? So if your mindset is to build that snowball and accumulate more shares, then you may choose to exercise the position. If you don't want to accumulate more shares, then you just sell the position and use that money for your next play. And that's usually what I do. The mindset behind rolling options is that you believe there's more legs in this stock. There's more legs for this run, for this rocket, or there's more fuel for this rocket. So essentially you just buy more time and hopefully it refuels and continue to rocket up. And the last method of holding until expiration is like you don't really care. In my instance is exactly the case because 5 contracts times 230 is like $1,000. Ultimately it's just a gamble. And because this whole position started with like 80 contracts, I already sold off 60 of the contracts the last couple of days at 3x. And I'm just taking a gamble to see if it goes to 4x, 5x, 6x. We'll see what happens. Let me know which route you like to take. Just selling it outright and move on, exercising, rolling, or just letting it fly. Like and subscribe if you found any value in the video. As always, thanks for watching, take care, and see you in the next one.